We were down 400 just briefly. Let's get to Bob Pisani. Hey, Bob.
We're getting, Carl, a much-needed pause and a little bit of consolidation after a remarkable run in some sectors that had been losers a couple months ago and have been extraordinary winners in the last month. So let's take a look at the sectors today. What have been the big winners? Bank stocks, energy stocks, retail stocks, industrials. What are the losers today? Exactly those four groups. Healthcare is a relative outperformer, but that has been a relative underperformer in the last month or so. Same thing's going on in Europe, by the way. We're getting the same type of pullback. So if you look at the movers over there, the banks like Societe Generale and ING are down. Aerospace and industrials like Airbus are down. The autos like Daimler are down. The energy stocks like Eni, that's the big Italian oil company, are all down. Same phenomenon happening over in Europe. And that's because we just had an extraordinary run in a certain subsector of the market in the last month. Just let me show you here. Banks have rallied 25% in a month, 25%. You don't think this is a rough climate for banks? Loan losses, fewer loans out there, lower interest income, ugh. And yet look at that rally there. Home builders up, retailers have been extraordinary. That's an equal weight index that I'm using. That I'm not talking Amazon there. Industrials as well, energy stocks up 20%. Retail has just been extraordinary. We've been talking about this morning. Of course, Macys had a smaller than expected loss and raised a bunch of money, and the Macys is up nicely this morning. But look at these moves. Macys, Gap, Kohl's, L Brands. This is 1 month. This is a 30-day period that I am using, and everything has been rallying rather dramatically here. I think our mission here is to explain the decoupling between the earnings estimates and the market performance. What exactly is going on? And I think if you look at what moves the markets, I've used this often, the market is assuming, it's ignoring the trough earnings and assuming that the policy decisions are all going to be right by all the actors. So on the reopening, the market's assuming that the decisions of the state officials to reopen has been the correct one and the timing has been correct. On the monetary stimulus, it's assuming the Fed's action on monetary stimulus has been not only right, but sufficient. On treatment and vaccines, we're assuming that the vaccine research is going to be successful. On trade war with China, we're assuming there's not going to be a massive trade war. Now, this is not fantasy. This is not prestidigitation. There is some evidence that the bulls are correct on all these positions, and that is exactly why the stock market has been rallying, because all four of these have actually aligned with the bull position. I think the problem now that the market is starting to hit is the valuation problem. Let me remind everybody what drives the stock market. Not why is the stock market up, but what drives stocks long term. It's three things primarily. Is earnings growing or not? Right now, they're not growing. They're still going down. Are dividends growing or not? That's not happening. In many situations, dividends are being cut. How about the market multiple, what we call the PE ratio? Well, that's the thing that's expanding very, very clearly. In my experience, you get the best stock market when all three of these things are happening. When earnings are growing, dividends are growing, and the multiple is expanding. We only have one of those three. We're going to need to see those earnings numbers really start to change and do a little bit better. But that's the valuation problem that we're hitting right now on a day like today.